Hello friends, Namaste and welcome all of you to my channel. Today I will be mainly discussing about the how to use the event study methodology in our research. The use of event study methodology not only limited to the accounts and the finance area, in economics, in marketing, when the company is going to launch the product, when the company is announcing the earnings, dividend announcement. Okay, it has a huge scope, I would say. So let's discuss about is the background of this your event methodology part. When we look at the history, perhaps we say the James and Jolly in 1933 you discussed this concept first, while the Bell and Brown in 1968, while the Fama discussed in 1969, developed as a statistical technique for empirical research in accounting and the finance area. While as for finance theory, we say that capital markets are perfect and whatever the information announced by the company that will be adjusted automatically in the stock price. That is about the market efficiency as discussed by Fama in 1965. Based on these premises, now as a researcher, if we like to study how the because of certain announcement of the we say the event, the company's stock return would be affected. Okay, that is the basic part. Now let's discuss about some of the example of your event, like your merger and acquisition. These days bank and financial institutions are in process of merger, even in case of Nepal also. Similarly, like your earnings release, if the companies announce the earnings, then they could also use the event study methodology part as a researcher. Similarly, dividend announcement, like your cash dividend announcement, alliances and the joint venture case. Similarly, corporate restructuring case, market expansions, when you would like to expand your business, like your Bhat Patani supermarket started its business in Birganj also. Then if that market is going to do the research, to what extent that market expansion announcement, let's see, then how it affects your revenue part, then you could also use the event study part. Now rating updates, like we heard the news about a few months back, like international agencies somehow flow the negative information about the Adani's enterprises in India. Now, because of that announcement, negative announcement might be there, then overall stock market of Adani's group of industries affected. We all know that. Similarly, government budget announcement, when the government announced the budget, then that announcement date could be the event. Then we could apply this methodology. That is the background of your event study methodology part. That's why I'm telling you this is not only limited to accounts and finance area. Now let's discuss about your event study timeline. Here I'm just taking care of your 41 days window. That's 0 is the government budget announcement date. Let's see. Now minus 20 is the pre, and this is the post part. This is called also the event window or observation period. Now second is the important point is that that's the 120 days is called the estimation period, or we say that is a clean period, which is mainly used to estimate your alpha beta. I will discuss in detail in next part. Then when we look after the procedures or the process that could be used while applying this methodology part, then first step, that is all about your estimating the market model. We say the market model is all about your the ER is alpha plus beta RM plus EIT. That is your ER is nothing, that is your expected returns, while alpha and beta are the constraint term and the beta coefficient. Okay, which could be estimated by using the regression technique over the estimation period, as I explained earlier, that is 120 days. Now second is all about your you have to find the actual return and the market returns. Actual return is all about your that's a rate of return on investment before, because as an investor we invest in the stock for returns, right? Then this is nothing, PIT is your ending price minus beginning price by beginning price, we say into 100. Similarly, I am talking about your Bombay Stock Exchange 30, that is your Sensex part. Then this is your again ending minus beginning by beginning value. Then remember, das return could be a positive or negative. Okay, if your value is increasing, then this could be positive or negative. Now third point is all about we have to forecast the expected return over the window period, as I discussed earlier, that is your 41 days. Now using the regression technique, we could estimate the alpha and beta and put this value in the our this model. Okay, then you could estimate the your market model and you could find the your expected returns. Similarly, fourth point, that is all about your finding the abnormal returns, okay, over the estimation window. Our abnormal return is all about that is, as I explained earlier, that is your abnormal return is your difference between actual return minus expected returns, deviation from your expectation. Okay. However, as for efficient market hypothesis, R equals to expected returns. There is no as such abnormal returns when the market is perfect or efficient. That is EIT equals to 0. Now the question is about how could we find the T statistics for average abnormal return and the cumulative average abnormal returns. That is all about your just you use the AARit at first find it, that is the sum of AR by N. Similarly, you could find the cumulative AR average abnormal return, that is your like your cumulative frequency. Then you could find the T static, that is your AR divided by standard error of your AR. Now similarly for CAR, you could find the CAR divided by CSE CAR. Now important point is that when you are testing your hypothesis, is there any announcement effect because of your on the stock returns, like your dividend, is there any announcement on the budget on the stock returns? Then we say when the T values are greater than 0 or statistically significant, then you say there is positive effect, if your announcement effect on the stock return and the vice versa. Okay, so this is very important when you are using the event study methodology. Then you have to be clear about your first of all your observation period, estimation period. Now you have to clarify all these points, and we mainly use the Excel while doing all these process parts. Then you find the T statistics, and then you finally you conclude your study whether there is positive effect or negative effect, and accordingly you could just discuss based on your literature review part. Okay, these are the references for this content. Okay, thank you for watching all of you for this video. If you like this content, please like, subscribe and share this channel. Thank you all of you. Please take care.